What I really want to do is take everybody through just a series of understanding approaches, thoughts, processes that something that I have found to be really very useful to me as I approach the things that I've done. And one of the things that I really looked at, and one of the things I've often seen in working with startups, especially over the last 4 years, where I've gotten involved in the accelerator ecosystem across the country, is that there isn't often truly effort put into a financial strategy that compared to the energy they put into maybe a marketing, a sales, a product development, a technology strategy that they're using to drive their business model. And one of the things that I have to share from my experience is that is really a very critical mistake. What you want to be able to understand is that a good financial strategy puts you in a position where you can adapt to market conditions, where you can adapt to new trends, and even be in a position to pivot, as we've seen through these pandemic times when businesses are no longer being operated and done the way they traditionally have been. One of the experience that a lot of small businesses experience during this pandemic is that it had immediate impact on cash flow, whether or not businesses went out of business or if they did any type of long-term contracting, customers shut down the operation. And even though you had receivables from those businesses, there weren't people in the office to pay those bills. And that created a dramatic impact for businesses today. And so one of the things that helps you through that is you really having a handle on your finances in terms of understanding how to manage them. And before we get started, I just like to ask a couple questions, and I want you like for you to see put your responses in the chat. I know we have a small group, but I'm curious to find out, what motivated you to sign up for this workshop. So if you can just drop some suggestions why you signed up for this workshop into the chat, I'll let Jake, kind of summarize it, and then I'll go into a little further about some of the things I was thinking about as I prepared to do the Smart Talk for the Science Center. So Jake, did we get any responses?
Yeah, here we go.
Okay.
Coming in right now. Let me see. Saul says 1 hour with the one and only Thom Webster. Priceless.
Stop.
Alessandra, Maddie and I are law students. So we have Maddie on the line as well.
Okay.
Maddie and I are law students at Drexel University Thomas R. Klein School of Law, and we're members of Drexel's Entrepreneurial Law Clinic this semester, helping startups. Yeah, Madeline says, law student, here to see if she can advise startups, better advise startups.
Okay. Okay. So that's good. And I think is it Maddie who shared that with us?
Yeah, Madeline and Alessandra. And Tracy
Madeline,
says, Thom is the
like to
man.
thank both of them for that. So one of the things that I did when I looked at it, say, okay, what's it really important? I have an hour because there's really a lot that can be talked about in an hour. And also too, finance can be very boring. But in terms of making it exciting and making the information useful, what I looked at is that I figured that what I wanted to do is just be able to help you gain something that maybe you didn't know before. If you have some particular concerns, maybe we can touch on those. And then always, when there is an opportunity for growth, you need to really look at, the financial implications of that opportunity to really make sure how viable it is for you and how successful you can be with it. So that's my thought process of how I approach looking at this Smart Talk today, and I'm going to be covering it and through those lenses. So one of the areas that I want to get into talking about first is that in learning something new, it begins with really increasing your understanding of how you look at the lens of business. What I found from my experience, when I look at an opportunity that I'm often approached about, I look at it from really three perspectives. One is profitability. And what I mean by profitability, not only is the venture making money, but how much more potential for how much more money it has to make in terms of it being profitable. Just because you may have large or generating high numbers of revenue, that necessarily doesn't equate to profitability. Two, cost. Cost is an overwhelming factor why businesses go out of business. Besides, not having a proper capitalization structure. But if you don't know how to manage your costs, it's just like everyday living. If you don't know how to manage your costs, then what's going to happen is that you're going to struggle financially throughout the endeavor. And then three is the growth potential. What are the opportunities for growth and how do you finance this growth? So we're going to talk about it from those three perspectives. So the first thing I like to look at when I approach any type of venture, you know, is the P&L, and often known as the profit and loss statement, often known as the income statement. Um, the P&L tells you a lot about a business and its ability to really generate revenue. And what it is that what the P&L is really designed to do is over a period of time allow you to track the revenue that's coming in and the expenses going out. And when you look at revenue, one of the things you want to be cognizant of in evaluating revenue are really the sources of revenue. And when you look at a business and a venture, whether it's a product producing venture or service providing venture, is that how is that revenue being generated, and it's being generated over time, and being generated over time, are there periods of time where the revenue fluctuates, and if so, why? That's when you begin to look at what we often refer to as the seasonability of sales. Is there a particular season why the revenue for this venture, it runs higher or runs lower than compared to other points in times? You want to be able to look at your numbers over a period of time so you get a perspective on how those numbers are tracking. And the same thing too is related to expenses, because the expenses associated with those revenues, which is often broken down in terms of your cost of sales, then your overhead, and then that can be broken further to variable and fixed. What you want to look at is those expenses associated with that revenue, how those expenses are tracking, and what impact does it have on your profitability. Because one of the things that you want to be concerned about in managing expenses is that the level of impact the expense has as your revenue fluctuate. And what you want to be able to do from that report is look at how you're making decisions now about money. Because what happens is in business, money is the lifeblood of your operation, and it allows you to continue to function effectively as you begin to manage through your day-to-day operation. And what happens through that is that when you begin to look at that in terms of how you decide what decisions you're making about whether it's about bringing on new employees, whether it's about moving to a new location, whether it's not about introducing a new product, one of the things you have to be considered what you have to consider all the time is how are the numbers telling the story? Because what you want to be able to do is really manage your business on a daily, weekly, monthly, quarterly basis by how the numbers are allowing you to make decisions. Because what happens is in business is that cash flow is going to be, especially in early stage companies, especially specifically with startups, cash is going to have a critical impact on you and your ability to carry out the vision and mission that you created this venture for. So if you're not looking at it from a perspective of how I'm driving revenue, how I'm maintaining expenses, and how my revenue is tracking in terms of what are the market conditions or that are creating either the sales opportunities for me to grow or that's limiting the sales opportunity for me to succeed. How are those things really allowing me to make greater, better decisions about how I'm managing this venture? And additionally, as we start to look at how we make decisions around sales, which is generating money coming in, and expenses that are generating money going out, there is another critical tool that we use called the cash flow statement. Now, one of the things that in a business, you really have three types of financial documents that a business live by: P&L, cash flow, and your balance sheet. Your balance sheet is not as critical for you in a business, especially during your startup phase, until you're able to reach a point that you're looking at: how do I raise capital or how do I obtain financing? But in but what is very critical to you manage your business on a daily basis in a very efficient way is really your P&L. And the one tool that I use very effectively, to me is my most important document I use to make financial decision, is my cash flow statement. Your cash flow statement really allows you to really look at how you are managing your cash. And it's also getting into looking at how your capital or how your cash is being sourced. So when you begin to understand your cash flow statement, the first thing you want to do is look at how you're forecasting your cash coming in. So if you're saying, well, I'm going to make, $120,000 this year on my venture, we always have a tendency to say, how's that $20,000 going to come in? We like to break it out over 10 months. That's $10,000 a month. But unfortunately, business doesn't work that way. And we often, in terms of creation of pro forma statements, look at planning our cash flow from revenue, equally out over periods of time. That can be deceptive in terms of how we're making financial decisions, in terms of the expenses we're looking to incur at a point in time. So one of the things that we have to be able to do from a cash flow standpoint is really understand how our cash coming in and where are the associations of the expenses with that cash at that time. One of the things that I know was really important in terms of forecasting with cash is that how is my cash coming in being timed? So looking at revenue trends associated with sales, because when you look at your sales has a cycle associated with it. And the sales cycle is going to start at the very beginning of identifying an opportunity or a target and converting it to a customer. And then you have to deliver the service. Then you have to bill for the service. Then you have to collect the billables. And so you have to then say, okay, what is my cash forecast for money coming in based on my sales forecast for closing on a new customer? And those are critical factors that we all need to be able to factor in making those decisions. So when I look at cash flow statements, what I like to begin to look at and try to analyze is that, based on these cash flow statements, that I reconcile with bank balances. Because when I'm looking at a deal, I'm saying, okay, if you're saying you're generating this kind of cash, let me look at the bank statements. And what those two documents are going to give me is a perspective of really how your money is coming in. Because that's very important in terms of making those kind of decisions about how I now going to expense the money. So if I'm looking at now, I got money coming in, I have a sales cycle, whereas it takes me 30 days to close on a customer that I'm able to identify as a target, then I know that if I'm closing on a customer in the beginning of second quarter, March, and it takes me a week to deliver the service or to deliver the product. And then my payment terms that I'm laying for that customer is net 30. And then all of a sudden, that sale that I'm looking at and booking in my forecast, my sales forecast, you know, for let's say $1,000 doesn't actually turn into cash until almost 6 weeks later. These are the things that we want to be able to look at and understand when we talk about the timing of revenue. Because in looking at and deciding on the timing of our revenue and in terms of its relationship to sales, it's about how it turns into cash. Because that's how you have to be able to plan for your expenses. So this really gets you then into that cash coming in and that cash going out. Because the challenge we always have in business is that we're going to have expenses. Going into business, day one, you decide to open your door, you are not going to be able to walk in the door, have a sale, have a revenue stream, have um, you know, have that receivable paid, without there being some time in between the steps process. And if we are not accounting for that in that, then what we're unable to do is really go down in terms of figuring out a financial strategy that allows us to understand our break even. So when I talk about break even, I know everybody's on mute and listening, and I'm so used to having opportunity to be interactive. Um, and we talk about break even, we're talking about really actually is when our revenue equals our cost. That's all break even means. Revenue equals cost. And so, and what happens is that for us to be able to have an effective business, if we don't have a break even, we can't make solid and good business decisions about our business. And once you have revenue exceeds cost, that's now you're talking about, gross profit. And so when you begin to look at the challenges associated with the necessary expenses um, around achieving around break even, you got to make good decisions around your cost of sales or your cost of revenue, and associated costs, which is those expenses directly related to direct sales and all the costs involved in calculating how do I make that sale versus overhead and expenses, what it takes for you to manage the business. And those are the areas that we look at in business that help us make the best decisions about how we manage our financials. So the other thing the cash flow allows us to do is to really understand our our ability to be liquid, and that is things that we own, equipment, machinery. If we're lucky enough to own real estate or have securities, that helps us on our balance sheet. It doesn't help us with our P&L, or it doesn't help us with our cash flow, but it's a nice thing to be in position to make us much more attractive to be bankable. Um, Also, too, cash flow is important for allowing us to help us define our financial needs. If we know that the cost for us is 6 weeks, we can round it up to 8 weeks, to convert a sales and actually collect the cash, then how do we really properly finance those expenses over that 8 week time associated with that? That's a part of understanding our capital needs in terms of how we finance our business operation. And I'll talk about that a little later. also too, being able to discuss your numbers from this perspective in terms of your P&L and looking at how your revenue is tracking, how you're managing your expenses, your cash flow, cash coming in the door, the timing of the cash and associated expenses with that. Being able to have that kind of conversation makes a lender very comfortable. When lenders look at providing you the opportunity for debt, and we'll talk about equity and debt, but my experience has been actually borrowing money to expand businesses and to acquire businesses, and to be able to talk to your numbers is a real strong is a real strong position that you're able to put yourself into, because one of the things you're going to need in any to build any type of business is that you're going to need a banking partner. And I tell small businesses all the time, you need to find a lender that you can start building a relationship now at this critical stage, because it's going to be essential that you have somebody you can go to finance growth opportunities. And what I like to suggest with them, and I'll talk about this a little later, a lot of times you just run off and you open a bank account with the same bank that you have your personal bank with, and that may not necessarily be the right option. So another question I have for those in attendance now, and I think I see we got about 9 people on. Quick question is that do you have cash flow problems? And if so, in your ventures, what are you learning about? What do you need to do about how to manage your cash? I'm just curious about throwing that question out there.
Not seeing anything come in through the chat right now, Thom. I think we
Okay.
have people here just looking to learn.
Okay. So let me just point some couple of things out. So one of the things that I like to say, some of the things, how cash flow can be used effectively to really help you manage your cash, is that you want to be able to set some cash flow targets. And what I mean by that is that if you're taking the time to understand how your money is coming in over what periods and how it's being timed in terms of its relationship by month, by quarter, you can look at then how you can really predict how you need to be able to plan, your allocation and your expenses. Another things that you want to be able to do is with customers is define real clear payment terms and even incentivize people for paying early. Nowadays with services, depending upon the business that you're in, you can actually have people prepay. And if that is the business model that you can get to, by all means, get there as soon as you can. If that's not your model, then you need to set up a model that allows you to invoice very quickly. Um, Back in business, going back 15, 20 years ago, business terms used to be, net 30, net 45, 1 or 2%, maybe 2.5% if you pay early. Nowadays, people want their money within 30 days. Now, the question is that especially during this pandemic times, we haven't seen it. I've seen several of businesses that I have investments in um, be challenged by being paid in 120 days. It's been that bad. But luckily, financially, we were on strong financial terms that we've been able to manage through that financial struggle. You always want to make your payments easy for customers. That is really how Amazon grew to success. Is that they they built built out a payout platform, a payment platform that you can pay within 3 clicks, which really revolutionized the industry. Um, there's also to an opportunity to offer fixed rate payment packages. And what I mean by that is that if you are in the service business or have a product business, what you want to really think about is that from a pricing perspective is there any way I can offer people a good, better, best? That's the example I like to use. So if I have a service package that allows you several options or maybe offer you a menu of options, I may want to look at how do I productize those options and say, well, look, you know, if you want these services on a monthly basis, I can give you this bucket of services for $1,500 a month based on an annualized contract. And then I can ratchet that up from a basic package to a full service package to something 2 to 3 times that. So that's what I'm talking about, converting it to payment packages. And you'd be surprised what you can do with that and how well that strategy works. Um, Definitely, um, you have to be able to make payment arrangements for those customers that are going to be late pays, because that's definitely going to impact your cash flow. Of course, having some type of financial platform, software platform like a QuickBooks or anything that allows you to manage your dollars going out and coming in on an ongoing basis, where you can check reports almost instantaneously. Um, and when I tell small businesses all the time is that, profit is good, but at a stage of business that a lot of small businesses are, and the small businesses I characterize as anybody under 10 million, you got to manage your cash flow. You got to manage your cash flow, and you need to, and based on your size, if it's not you, the founder, or you, the president, or you, the CEO, you need to have somebody on your team that is in a leadership role that is going to be responsible for managing the financial strategy of your venture. And then that totally relates right to you monitoring your activity on an ongoing basis, having weekly meetings, looking at bi-weekly reports to allow you to understand what's going on so you can catch problems early, because problems are going to happen. And then also to back to the bank. One of the things that I tell people all the time is that your best banking partner really is a small regional bank, or depending upon your size, even a community bank that you can create relationships with. The reason is that you want to be able to build a relationship with the decision maker. If you if you if you're banking with a large national bank, the Wells Fargos, the PNCs of the world, you're dealing basically with some commercial lender that just is collecting your information and passing it off, to other decision makers, that's going through underwriting, that's going through bank approval. That really is who doesn't know you, have a relationship with you, that's making a decision about whether or not you're worthy for any type of, if any type of lending. Um, but if you are working with a small community bank or small regional bank, which has always been my preference for the last 25 years, you build those relationships, because at the end of the day, what happens is that in being evaluated, even though you may have some problems, being able to explain your solution about how you're going to address this problem goes directly to them making a decision about whether or not to make whether or not to offer you terms and offer you capital and make a loan to you, based on their understanding that they have confidence in you and your ability to repay. So that leads me right into this next section. So anyway, before I jump any further, I'd like to throw out there: are there any thoughts, any questions, or does anybody have anything they would want to ask based on anything I said so far? Whether it's related to using your financial statements like your P&L, your cash flow, or understanding, timing for revenue as well as your expenses associated with that?
Not seeing anything come in just this
Okay.
second.
I think I'm putting everybody to sleep.
No, no, not at all.
Okay. So let's talk about financing for growth. So one of the things I look at as I go into an adventure in making some decisions about how they making their money, how they're managing their expenses, is that if there's an opportunity, is there if there is an opportunity there, how can I finance that opportunity for growth? And if I can't if I can't get my arms around how I can how I can package the business and package their financing, so that I can get money, to expand the business or to acquire the business or to assist the business, then it's not a good, it's not nothing that I can really do. And the numbers tell the story, as I've been sharing with you so far. So one of the things I look at is that in terms of financing growth is that, what are the real capital requirements for making a decision about how this business plans to grow? And does their history support the growth opportunity they're saying that they have? And in that understanding and in that communication, are they able to talk about their financial goals? What are their potential capital resources? What are their funding requirements? And what is the timing that they require for them to meet their forecasts and projections? So when they're able to explain that to me, or I'm able looking at a number, get an understanding from that in terms of how I'm able to assist them or support them with that strategy, then I'm able to look at creating a financial strategy that's either going to be able to assist them either through equity or through debt. And equity is actually, for me, especially as an African American in business for 35 plus years, was something that was unheard of and unfamiliar, I would say, except within the last, 5 to 10 years. Um, One of my first ventures I was involved in 30 plus years ago, we were able to grow our business from 2.5 million to 10 million, through debt. And that debt came in the form of government lending programs. Government lending programs, I'm going to talk about that in a little bit, have a tendency to be overlooked. But equity is something that is really very new, for me, but I know it is all the rage, and everybody, wants to go out and find an investor that's going to invest in them. And what I found from discussions from people who want to look at how do I get somebody, to give me money, is that they don't have a strong sense of how equity gets structured. So here, from an equity perspective, what I like to be able to do is first tell people is the first thing you have to be able to do is quantify your sweat equity. And your sweat equity is starts with yourself and what you personally and financially have put into the business. I have not met an investor yet, including myself, who's willing to invest in a business that someone hasn't put in their own money into. I don't Sweat equity. I get it. You've been working at it, and that does have some value. But what you have to be able to do, and what I find also too from talking to people, they even haven't bothered to take the time to track, even though somebody may say, "Oh, well, I haven't had the cash to put into this." But the reality is that every day as you launch this venture, whether it's purchasing of a piece of equipment, whether it's going to a workshop or seminar, whether it is hiring an attorney, to help you do your incorporation, that's all money that you need to quantify that goes on the balance sheet that is accountable as part of your sweat equity. And if you take the time to add those numbers up, you're going to find that you've actually invested more dollars into your venture than you ever thought. Then, in addition to that, you add your time and energy. And what I tell people, you calculate your time based on your highest work experience in terms of what you were making in terms of when you were in the job market. And then that's the value you assign to your time that you put into the business. And then the other part of it comes from anything else that you can quantify that you can then associate with the value that then becomes something that you're able to show and justify on your balance sheet is what you're calling your sweat equity. Family and friends. So that is something that is really unique to people um, that have relationships with folks that have disposable income. So part of the challenge that exists with a lot of startups, especially startups who are diverse founders, is that normally they may be the first in their family or within their sphere of network of people that are going into business, you know, or have access to capital, have have retirement beyond, Social Security that they are able to share with you and invest as an investment because they believe in your dream. Um, Family, and when people look at doing family and friends rounds, the key to family and friends round is really not the opportunity. It's all about you. It's about people getting behind you. And what I like to tell founders is that people getting behind you because they believe in you and they want to see you succeed. You know, and in that, you know, there definitely needs to be clear terms as if you would do with any other type of investor so people understand that this is a professional relationship even though they may be, you know, an uncle or aunt or a parent or a cousin or brother or sister, but and that keeps everything above board. But at the same time too, they're there understanding that the risk is going to be high and that there's a high probability that the money they're giving you is money that's going to be lost, because 90+% startups fail. That's okay because they are investing in you and they believe in what you're doing and they're trying to see you succeed. And so that's really where family and friends comes in at, and where that works again is having access to people that are family and friends that have disposable income. Equity capital, we all know what that is. And in equity capital, you have really, the different stages where you go beyond family and friends and you get into, your seed and your series A and your mezzanine round. Um, those are structured and based on risk capital. But those are really much more defined. They have and they're really based on the potential valuation of your venture and what does the rate of return look like for the investor in terms of their investment goals. A lot of times when raising equity capital, what happens is that why you often get turned down, you haven't taken the time to understand the investor's goals in terms of the rate of return that they're looking for. And for your venture to be able to then align with their rate of return is what gets you the interest of the investor to consider you for investment. So those are, the really three primarily strategies for raising equity. And as I said to you, I was in business for over 25 years before I was able to see my first equity deal. And my success that that is often overlooked, is really, um, debt capital. And it is really not as hard or not as challenging as you can. And it just requires you to be a little bit more thoughtful, a little bit more tenacious, and really strategic about how you're managing your money. And, and you know, and debt capital is really you getting a loan, um, from some entity that that is lending you cash, that can be structured in a number of different ways. You have I've had several examples up here, whether it's line of credit, equipment, invoice financing, you know, um, merchant cash advances, LCs. Um, those are some of the more non-traditional. You got your traditional, your credit cards, your real estate loans, your business, your public financing. But let me talk about public financing. Um, One of the things that you will see that, um, as we see now with everything from, PPP because of the CARES Act, um, as well as, much more money now going into micro lending than any time in the last 25 years, is that you have an opportunity to really get extremely favorable long-term loans, and even through PPP get forgiveness on loans that you would not normally have had access to, that can really be significant for you in terms of your financial strategy. One of the one of the opportunities with PPP, which is really unheard of, is the opportunity to have, those loans converted to grants, which means you pay back nothing. But the general terms on PPP loans has been the average monthly debt service on a $25,000 PPP loan right now is $35 a month. So you're talking about money, cheap money. And so those are the things that you want to be aware of and look at when you begin to look at opportunities in public financing. A lot of times entities, they say, well, these loan programs want all this paperwork and I don't want to do the application. And I tell people all the time, for a point, 2 points below prime on any type of loan in a good or bad year, you know, cheap money, do the paperwork. You know, it doesn't make any sense. And there's been programs that over the years that actually ventures I've been involved in, I've been able to borrow millions to do deals, do projects, expand business. And the money is extremely affordable. And then also, too, what it does is being able to demonstrate, whereas a bank may not have willing to loan you $500,000, being able to get a loan through a government program and then paying that back allows you now to walk into a bank and say, look what I've done. And then all of a sudden now you're viewed as bankable. The other thing that people don't think about in businesses, especially if you're in a product business, is merchant accounts. You want to look at merchants accounts and lines of credit. what merchant accounts and lines of credit do, it allows you to have the manufacturer or the wholesaler of the product that you're primarily reselling or buying parts from to make the product that you are selling, to give you terms in terms of to provide you with terms for you to sell that product. For instance, prior to the pandemic, in several wholesale businesses, food, furniture, and construction supplies, companies were being allowed up to 90 days to pay on the products that they were sending or acquiring from the wholesaler or the manufacturer. So if I was buying light bulbs from GE and turning around and reselling them to a customer, GE was giving me 90 days to pay for that light bulb. And since now most companies buy based on time inventory, and that is I'm only buying the product when somebody orders it. And then if I have, going back to payment terms, I have the people prepaying, I can then have that manufacturer not ship the product to me, but ship the product directly to my customer. And all I'm doing is collecting the money, and then I still have 90 days to pay for that product. And that right there, or they're basically what we call merchant cash advances or lines of credit with merchant or wholesale providers, that allows us to hold on to our own cash, while we're driving and generating sales. So those are some common financial debt structures that you can use to be smart about how you manage your cash flow and how you build profitability in your venture. And long term, again, being able to have that banking partner, that small regional banking partner, working alongside of you, when they see that type of activity, when they see that type of strategy, when they see that you are able to apply those type of methodologies to the decisions you're making about money and managing your business, your banking partner is going to work with you, and you're going to find your ability to borrow money is going to become a lot simpler. So in closing, what I want to be able to do is just share some key principles and tips that I use in terms of developing an effective financial strategy to manage business operations. And that is, one, you got to have skin in the game. Two, you need to understand the different ways you can borrow money that allows you to be smart about how you manage money. Three, got to know your financial statements. Again, your key ones are your P&L, your profit and loss, and your cash flow. Understand your working capital needs. How much money do I need to manage my business based on my revenue sales cycle? Not based on what I need, based on, talk about it in relationship to revenue. Be lean on your fixed assets. A lot of times people borrow money to go out and buy things they really don't need. And really what you need is working capital. Three, got to have a plan. When you go to a bank and looking to make loans, first thing they're going to want to see is that what's your business plan. And once you have a banking partner, and once you give them a business plan one time and they're comfortable with it, they'll never ask for anything like that again. Know your credit. That's something that's really very important. And, and again, credit is really based around, what is often referred to as the 5 C's of credit. And that is character, capacity, capital, collateral, and conditions. Identify your equity, know how to put a value on yourself and what you contributed so far to your business and to get it to where it is. And And then last is know your financing options. There's a lot of options out there for debt. You want to explore them all, understand them all, and pick the one that is the right one for you. So that kind of summarized what I wanted to discuss with everybody today. And I don't have anything else to share at this point, but I am open for questions from anyone.
Excellent. Thanks so much, Thom. Yeah, if anyone does have questions, feel free to make use of the chat, or you can also feel free to unmute.
Yeah, I see. Hold a minute. I see there are some questions in chat.
Yeah, this is one from Brandon. So this is actually a note, and I believe this came up during your equity points. But Brandon said,
"Oh, what's up, Brandon?
Hey, Thom, what's up? Good presentation.
Thank you very much.
I was my comment was just to agree with you that especially for, and I get the sense that a lot of the people on these calls are really early stage, like like me. And I was just gonna say that being early stage, being pre-revenue, I saw a GIF that Damon John put on his Twitter where it was like every pre-revenue startup and it's somebody running away. So I think if you can lean into relationships, like you were saying, it makes raising funds at that early stage, especially for a founder like me, where I don't have a dollar to rub together to put into a business. Like I have to pay rent, right? So I'm just starting out. So being able to lean on those types of people, I think those relationships are really important.
Yeah, and you've done well. You and I've had this discussion, and I've had the pleasure of working with Brandon and his company ARC for the last year at Launch Lane, and Brandon's being very modest. He's come a long way since he came into the program.
And I've got a long way to go before I can start worrying about. But yeah, no, and so just another opinion is to agree with what you were saying around relationships.
Mm-hmm.
Thom, what's your take, since I've got the mic open? What's your take on raising debt with like an obligation to your personal finances? Like if you have to put up your, like something of your property as collateral, is that a smart thing to do as an early stage company?
Is it yours or family members or?
I'll leave it open ended.
Yeah, it's like I shy away from that. I do. I know that at the early stage there's such risk, and you want to hate to see somebody lose their home. But I don't, and I don't recommend that to others. But another option is that how I've looked at investing in the past is really when I've decided to make investments. It's really been against my 401k or my stock portfolio. And I can borrow against that without having to take anything out, and then making and then using that access to capital. Borrowing money. I can borrow money against other, liquid assets that I have to make investments. And that's what I've done in the past for investments I've made.
Yeah. So in other words, like don't bet the bread on your table.
No.
Against. Yeah.
No. Not at all. Hey, Tracy.
I remembered to turn the unmute button off. Thom, thank you so much for amazing insights. I mean, and practical insights. So it wasn't, as you started out the presentation, boring finance 101. It was like a life lesson on finance. So thank you very much.
Oh, you're very welcome. I mean, most of this stuff I learned through trial and error because I made some mistakes. I've made some. I've lost my share of money, but to me, I just looked at it as God's plan. I never lost my house though, but I've had some losses. Yeah.
Thom, would you say that you're a risk averse person?
That's a good question.
Well, at my age now, yeah, I am. Yeah. 20 years ago, I was frivolous, to say to speak, you know. I was very, but it all balances out. You know, nowadays I'm not more strategic, and what I've learned as an angel primarily is that at the end of the day, I invest in people. I mean, you can have the best business model, you know, the greatest, you know, financial strategy. It all comes down to your ability to execute. You know, that's what I look at. Can you execute? And it's not you say that you can. Is it in your history that you've established yourself with success somewhere? You know.
Tom, I thought that was what was particularly interesting to me in some of the comments that you were sharing, just in terms of some of these like financing skills demonstrates your willingness to learn and be flexible, and demonstrates to bankers like you're in to win. You're not just going through kind of the transactions. And so I thought those were really interesting insights, and ones that I will definitely share with
Yeah.
entrepreneurs going forward. So
Yeah.
I'll steal them from you.
Yeah. My banker has been my banker for 20 years, and I've followed him to 3 different banks.
Mm-hmm.
And when you have that relationship, that's important.
Right.
Yeah.
Yeah. All right. Well, we're right at 3 o'clock, so that's our time. Thom, thank you again so much for all of this insight. Really appreciate you sharing.
Jag, it's been my pleasure, and thank you for considering me. And again, this is my first virtual workshop like this, so I was kind of nervous. It was like, okay, I'm used to interacting with people, and but I've had enough practice with Brandon over the last year.
Well, yeah, you would have fooled me. This did not seem like your first shot at it, so thank you again.
Oh, it's my pleasure, and always, you know me, I'm always here to help because I appreciate the work we're doing at the Science Center and the stuff that you're including me in.
Absolutely.
Yeah.
All right.
Thanks,
Well,
Tom.
All right, everybody. Thank you.